Michael, you're initiating a buy rating and a price target of $55.
Yeah, thank you. The fundamental story here is we just think Uber is going to be a much bigger company in several years than it is today, and that's really predicated on their core business, which is ride sharing. We just think that's going to really alter the personal transportation market over time. When we look at our model for Uber, we see that we only expect them to have as customers about 7% of the smartphone users in their countries by 2023. We think that's a very conservative number, and it's going to be a lot bigger over time. Anecdotally, we don't know anyone who's not using ride sharing more and more these days, and so we just think that that's the core. And then you layer on some of their other businesses. Uber Eats is a fantastic business that has also got a lot of room for upside. Restaurant delivery is only 10% transacted online in the United States, and that's the market that's the furthest ahead out of all the countries. So we just think they're in some big businesses that they can execute well on.
What do they have to do to turn a profit on ride sharing? Because right now they're subsidizing every one of these rides that gets taken.
So very importantly, the pricing environment in the U.S. in this business seems to be getting a little bit better. What you saw in 2017 and 2018 is Lyft came on to the scene in the U.S. and started really ramping up in more and more countries. And there was some aggressive price competition going on. What Lyft said on their earnings call the other day was that they are seeing a more rational pricing environment. Uber echoed that on their earnings call last week. And so, I think that's a really good thing. When we initiated on Lyft.
Did they show you any numbers to make you think that, or is it just them saying they think people are going to stop discounting?
So we have in our note on Uber this morning, we have some data that we gathered. It's a tracker on sort of the rides and the price of a ride in 6 major cities across the U.S. And we see that uptrend happening over the last couple of months. So that's sort of where we're getting some of that conviction.
So you think part of it is that both these companies are now public and both have investors to answer to and can't be losing $1 billion a quarter like they have?
I think that's
or like
part
Uber
of it.
Has, I should say, not Lyft.
But I think the bigger thing is both companies feel like a duopoly or something close to a duopoly is a pretty good way to kind of go after this.
What if there's a third competitor like Elon Musk?
Clearly, there are going to be more competitors trying to come into the market. What we think is that these are two-sided networks that you have to build up in local geographies and local cities. It takes a lot of capital and a lot of time to do that. And then you have to have a lot of data and a very smart platform so that you can price rides at the right price, get the car to the right place at the right time. Very complex. So we think that it's going to be harder for new entrants to come in and compete effectively against Uber and Lyft in the U.S. and then Uber and their principal competitors in other countries as well.
So when do you expect them to actually turn a profit?
Well, 2023 is when we're modeling EBITDA profitability for
4 years
Uber.
from now.
Yep, and
that's a long ride.
It is a long time. It's not uncommon. It's not dissimilar to what we've seen from companies like Amazon, right? And one of the things that
Amazon wasn't losing $1 billion a quarter in the meantime.
That's true. I mean, Uber's got some big losses ahead. What we think is that investors are, ultimately going to come around to the idea that Uber's well positioned for growth, and that they're going to be able to execute on all these things and really be one of the growth darlings in the tech sector going forward.
What about all of this new focus on technology? I realize that regulators and Congress are not looking at Uber as part of this big group. But if you have the situation, as Scott has pointed out, that you can expect a different regulatory environment over the next decade, does that concern you when you are focused on just having a growth company and hoping for profits down the road?
It's a little bit concerning for that, Facebook, Google, Amazon group. Clearly there's a lot more heat on those companies than there has been historically. I do tend to think they're going to get through it. One of the things that we've seen with the tech giants is that when you get new regulation, like GDPR in Europe was a great example, these companies are so well equipped to just figure out the right way to navigate through that. So unless you get really dramatic action and like divestitures and breakups, it tends to be sort of manageable for the tech giants. I don't think Uber is going to necessarily fall into that antitrust category. I mean, they're going to have some legislative issues on other fronts, but I don't think antitrust.
Scott, you're a Lyft guy.
Yes, we are a Lyft guy.
You're full on Lyft.
Yes.
How long will you stay in Lyft now that it's a publicly traded company?
Don't know is the honest answer. So in general, right, the way our business works is once things are public, our LPs are looking to us to say either you've got some view on where this thing is going to go over a long period of time, or quite frankly, we've got public managers that we're not paying you to manage our public stocks.
What do you make of the argument that both of these companies stayed private far too long? The amount of growth opportunity already took place in the private market. The entire sort of audience demand opportunity in terms of investor demand was completely tapped out in terms of every private wealth guy at Morgan Stanley and at Goldman Sachs and Blackstone and T. Rowe, meaning there wasn't some new,
I think that's
some new investor class.
Yep. I think that's true. It's more true with Uber just because, look, the sheer amount of capital they raised was obviously a lot higher, and there was much more of a retail distribution that they did, leading up to that. Look, I think if you look at the growth, the big difference to me right now between Lyft and Uber is, Lyft has very significant growth in the core ride-sharing business. Uber, is very, very focused, obviously, on some of these ancillary businesses. I'd be curious, Michael, how much you think the story is Uber Eats and the non-ride-sharing businesses relative to the kind of more moderate growth they're seeing in the ride part.
I think they're slightly different stories for investors. We're bullish on Lyft as well. We have a buy rating on that stock also. Definitely a more contained investment profile, and probably will get to profitability significantly sooner than Uber will. And then you take Uber as more of an Amazon-like model where they're trying to be global and they're trying to be sort of all things to all people over time. So I do think they present, fundamentally sort of different investment profiles going forward.
Right.
But I think both companies are well positioned.